I'm Mark Roach, and this is Future Wise Energy, an innovative voice, an independent upstream energy platform. And to respond to a recurring question, no, this is not AI. The paradox of efficiency in American oil production has never been sharper. We're setting new records while machinery that got us here is running backward. American crude oil production hit almost 13.9 million barrels per day, the highest that we've ever produced. Yet our rig count sits at 417, down nearly 13% year over year. We're doing more with less. We're also drilling wells and not completing them and bringing them online as fast as we did at one point in time. WTI crude is trading around $59.36 per barrel today. Brent sits at 63.72. These prices are down 14 to 16% from where we closed 2024 last year, but they remain well above the 5-year trough. Now, the real divergence happens in natural gas. Henry Hub, as we've been talking about here, these spot prices surged to $371 per million BTU as of November 17th. That's 125% gain year over year. Now, December NYMEX futures jumped about 4% as cold weather forecasts swept across the eastern U.S. The Permian Basin maintains its dominance with 253 active oil rigs. The Eagle Ford, well, it remains steady at 41 rigs, but that's down 7 compared to last year. The frac spread, listen up here, these crews have declined for a third consecutive week to 173. And this is worth watching because this may have more to do with sustaining production than the rig count, obviously. The message is unmistakable. Operators are being cautious about completion activity in a lower crude environment, lower crude price environment. The geopolitical lens has shifted dramatically. U.S. sanctions on Russians Rosneft and Lukoil took effect November 21st. These companies account for roughly half of Russia's oil production and exports. Indian state refineries announced plans to cease Russian oil imports entirely. Russian oil export revenues have collapsed to their lowest level since nearly 3 years ago, which were at approximately $1.22 billion per week. Urals crude has plunged as low as $36 per barrel, with discounts against the Brent widening to $23. JP Morgan estimates roughly 1/3 of Russia's oil exports are now sitting idle in tankers waiting for buyers. Now, on the corporate front, SM Energy and Civitas Resources announced a merger valued at roughly $12.8 billion, including debt. Now, this creates one of the largest independent U.S. shale producers by output and acreage. The combined company projects more than $1.4 billion of free cash flow in 2025 and up to $300 million in annual cost synergies. ExxonMobil and Enterprise Products Partners, though they announced a strategic partnership on the Baja NGL pipeline in the Permian Basin. ExxonMobil is acquiring a 40% stake in the 550-mile pipeline with initial capacity of 600,000 barrels per day. This reflects confidence in long-term NGL production growth in the Permian, which is expected to jump over 30% between 2024 and 2030. Permian Resources raised its 2025 oil production targets by 3 million barrels per day to 185.5 million barrels per day. and a total production by 9 million barrels of oil equivalent per day to 394 million BOE per day based on strong well execution. The company now has firm pipeline capacity for roughly 330 million cubic feet per day of gas output in the basin in 2026, expanding to 700 million cubic feet per day by 2028. U.S. LNG exports reached 10 million metric tons in October 2025, making us the first country to achieve this level. We've posted 4 consecutive months of record high LNG exports driven by facility ramp-ups at Venture Global's Plaquemines Export Terminal and Cheniere's Corpus Christi Stage 3 project. Golden Pass LNG is expected to load its first cargo in February 2026. But the International Energy Agency has drastically worsened its demand outlook. It's now forecasting a 4.1 million barrel per day surplus in 2026. Major investment banks like Goldman Sachs have cut 2026 price forecast. They're now expecting Brent to average $56 a barrel and WTI to reach $52 per barrel next year. The Trump administration has pursued an agenda to maximize domestic energy production. Executive orders declare a national emergency related to energy production and authorize the Department of Energy to exercise emergency authority. Metallurgical coal and uranium have been added to the critical minerals list. Multiple executive orders targeting quadrupling U.S. nuclear capacity by 2050 with directives for expedited licensing. FERC has waived existing rules limiting initial construction activity for natural gas infrastructure. The Trump administration concluded its first SPR purchase, buying 900,000 barrels of sour crude from Trafigura and Energy Transfer at an average price of $62 per barrel. SPR, this Strategic Petroleum Reserve inventory, rose by 500,000 barrels to 410.9 million barrels. American crude production continues setting record with declining rig counts, as I talked about earlier, reflecting an unprecedented operational efficiency and capital discipline. The productivity is occurring within a context of pronounced oversupply, with crude trading well below long-term averages. Natural gas markets tell a different story, with prices rallying at 125% year over year on winter demand expectations and strong LNG export demand. The Trump administration's pro-fossil fuel agenda supports pipeline infrastructure, coal and nuclear energy alongside oil and gas production maximization. Major consolidation in the 5 mid-cap upstream space signals renewed scale-seeking behavior between, or even though overall M&A activity remains muted by historical standards. There's just fewer players. With surplus global supply expected to expand into 2026 and analyst price forecast trending lower, the market appears to be pricing in continued structural headwinds. The operators capturing the next cycle won't be the ones chasing volume. They'll be the ones who understand and are connected. And those that really do understand, scarcity isn't about how much is left, because there's plenty. It's about what can be brought to market and when that matters. The most profitable moves in this industry can happen when capital is absent and commitment is clear. Sounds like a contradiction, but it's true. That's where the next round of advantages get built. Position yourself not just for today's market, position yourself for the moment when everyone else has to play catch up. I'm Mark Roach, and this is Future Wise Energy. Be precise about what you know. Be skeptical about what you're told, The energy transition isn't a line you cross, it's a cycle that you navigate.